Hello, everybody. Ian Maddox, Hitchcock Maddox Financial Partners, connecting with you on our Financial Planning Simplified video series. Every couple of months, I like to remind our viewers why we call this the Financial Planning Simplified series. And really, that concept of financial planning simplified is something that we carry through philosophically in the way that we run our business and the way that we interact with our clients. So part of our goal here is education, and part of it is to really break down the planning process into smaller pieces that are easier to understand. Our job is to serve as consultants and advisors and to make that process more understandable for people over time. And so that's our goal. That's the goal of this video series. The last couple of weeks, you will have noticed that we've interviewed folks here in the community, and we like to do that on a regular basis, and we'll continue to do so. But today I wanted to talk a little bit about something that has come up here with Richard and I, and if you turn on the business news, some of the talking heads refer to this idea of a disconnect between the market and the underlying economy as we continue to face pandemic. We continue to see the toil economically that this event has created for the world, for our country for sure, and if you're right here in Alabama, our own state. And the government has done a ton, as we know, to try to prop things up and to create stimulus to inject us with medicine, economic medicine, financial medicine. And so we continue day by day to go through this process. So this idea of disconnect between the markets and economy, let's talk about that for a second. First of all, there has been a historic bounce back from what they call a bear market, right? Anytime you drop 20%, we get into what's called bear market territory, back to a new high on the Dow Jones Industrial Average. Okay, the S&P is about the same. It's not quite to a new high, but it's right in that ballpark. That has never happened. 126 days from bear market trough, okay, or bear market valley, back to new market highs, 126 days. Historically, that has been a five and a half, pushing 6-year process on average. We've only had a few other times when it's been fast, and it's been 2 or 3 times longer, and we have to go back to the 1960s to even find that. So that's been a historic bounce back. Why is that happening? A couple of things. Again, I mentioned the injection of financial stimulus from the government. That has absolutely been part of it. You have also seen tons of, sure, institutional investors, but lots of retail investment activity. And this might be a little frightening, but there's been a lot of leverage involved as well. So there's just a lot of investment activity going on. The issue that I think that we should all be aware of, and I'm not going to come to a conclusion and be able to provide you with exact direction as to where we're going next. That's just a difficult thing for anybody to do. But what I can tell you is that if you look at the S&P 500 largest publicly traded companies that are headquartered in the United States, it is a market cap weighted index. In other words, if a particular position of those 500 happens to be going up very rapidly, the index math basically gives that more weighting. Right now, you have Google, Amazon, Facebook, Microsoft, okay? These positions are right now sitting at about a 23 or 24% weighting of the entire S&P 500. If you take an equal weighting, in other words, if I take the 500 positions that are measured by that index and I give them an equal weight, in other words, each one is 1/500th, that index, those positions are actually down 4%. We've not recovered across the broad stock market. You have a sector in technology that has driven, it's out there on the tip of the spear, driving us forward. What does all that mean? I think it's just something to be aware of. I probably sound like a broken record when I tell folks again and again over the years that this is another example of why you need to drive back to your specific plan, whether you are working with an advisor, your tax account attorney, whatever, whoever it is you go to for advice. Like I've said, make sure that you're tying back into something, because that is kind of an anomaly. And certainly I would tell you that anytime you have retail investors using leverage to buy speculative things, right? Because we don't know exactly if that's going to work. Is technology truly going to drive us out of this, or is it a bubble? do we have prices that have gone too high, too fast, and they're going to pull back? They're going to retrench. They're going to settle back down to something that's more reasonable. Either one of those could happen. I'm not predicting one or the other. But what I will say is that there certainly has been some speculation going on and leverage involved. And when you put leverage and speculation into a blender, it usually produces a pretty gross drink. In other words, there's a lot of risk there. That's not something that I'm comfortable with. Don't advocate that for clients. And so it's something that if you're watching this video, just to be aware of, there is more of a connection with the broad stock market to some of the underlying weights that are on the economy. We just happen to have a sector of the economy that is weighted, that is attractive for investment, that literally we've just put high octane jet fuel in it and it's shot to the moon. So always want to provide good information to folks on these video series, help you guys make better decisions. If we can ever be of help, give us a ring, check us out on the web, shoot us an email. As always, Ian Maddox, HMFP. Till next time, bye-bye.